The Neptune Orient Lines (NOL) was one of Singapore's most significant and influential maritime enterprises. It was the heart of the nation's national shipping lines and played a role in the country's industrial growth. Since its incorporation, NOL as a company grew to billions of dollars and employed thousands of people, impacting the very lives of Singapore. Yet, due to a string of unfortunate events, the Neptune Orient Lines would be sold off to foreign companies, ending the streak of a company once owned by Temasek Holdings, Singapore's national sovereign wealth fund. Neptune Orient Lines was established on December 30, 1968, under the Ministry of Finance, with the vision to support Singapore's industrial growth by transporting a share of the nation's trade at fair freight prices and ensuring a supply line of essential cargoes during crises. A year later, the ownership of NOL was transferred to Temasek Holdings in November of 1969. There were several key figures in its early development. These were then Finance Minister Goh Keng Swee, who was instrumental in the company's planning and establishment, along with Hun Swee Sin, M.J. Said, Goh Chok Tong, and Eric Khoo, names who would eventually become important figures in the Singaporean economy. Under the leadership of its first managing director, Said, NOL's initial priorities were acquiring ships to launch a conventional liner service in the Far East Europe trade, linking Singapore to its main European markets. In 1969, NOL acquired its first ships, Neptune Topaz and Neptune Zircon, followed by Neptune Amethyst and Neptune Aquamarine. NOL faced initial challenges as a newcomer in the Far East Europe trade, particularly in dealing with the Far East Freight Conference, FEFC, which controlled most of the trade and set freight rates. But despite these hurdles, NOL secured deals with local and foreign companies, expanded into the Australia trade, and diversified into the charter and tanker businesses. And by 1973, NOL's fleet had grown to nearly 20 ships. Despite these efforts, NOL operated at a loss until 1975, when it recorded its first profit under the leadership of Goh Chok Tong. NOL implemented a cargo management system to optimize earnings per voyage and improve efficiency by separating ship-owning and operating concerns. The company also embraced containerization, revamping its fleet with new, fully cellular vessels and converting existing semi-container ships. In 1975, NOL formed the Asian Container Europe, or ACE, consortium with several other shipping lines, becoming a significant player in the container shipping world. By the end of 1976, ACE offered fixed-day weekly services between the Far East and Europe. After Goh Chok Tong left NOL in 1977, Lua Cheng Ing succeeded him. NOL broke into the profitable Trans-Pacific route between Asia and the United States and invested in terminal infrastructure in the U.S. Following several profitable years, NOL was listed on the Singapore Stock Exchange in 1981, raising 155.7 million Singaporean dollars, which was used to purchase new ships and build the NOL building. In 1986, NOL experienced a loss due to a slump in the shipping industry, but rebounded in 1988 with a record profit. Temasek Holdings reduced its stake in NOL to 49% in 1988 to remove it from the U.S.-controlled Carrier Act, allowing NOL to align its shipping rates more closely to market conditions. By the end of the 1980s, NOL had diversified into logistics, ship management, and marine services. And in the early 1990s, NOL expanded into the lightering business with American Eagle Tankers, AET. In 1994, NOL reported its first half profit. They said that pre-tax profit came out to 25.2 million Singaporean dollars, whereas revenues amounting to 883 million Singaporean dollars. In the same year, an NOL tanker named Neptune Aries crashed into a jetty on the Saigon River near Ho Chi Minh City on October 3rd, spilling more than 1,500 metric tons of diesel fuel. This caused environmental havoc and led the Vietnamese government to demand over $20 million as a damage deposit. This was claimed to be Vietnam's worst ever oil spill event. Moving forward to 1997, NOL announced one of its biggest acquisitions to date, which was the acquisition of American President Lines, APL, for over $825 million. This acquisition was seen as ambitious and led to regulatory review to ensure it won't cause any issues. But as the two industry giants join together, this will substantially enhance their influence on the Trans-Pacific trade route, boosting their combined market share to over 10%. Combined, they will operate a formidable fleet of 113 vessels, which includes 76 container ships with a total capacity of 200,000 TEUs. By merging NOL's strong presence in the Far East Europe trade lane with APL's specialized expertise in the Trans-Pacific market, the new entity will emerge as a truly global carrier. A year before this announcement was made, NOL and APL reported a combined revenue of over $4 billion. The CEO of NOL back then said that this acquisition will bring in annual cost savings of at least $130 million from the consolidation of operations and enhanced efficiencies. And by the end of the year, NOL became the 7th largest container lines in the entire world, leapfrogging South Korea's Hyundai Merchant Marine and Japan's NYK line. The year prior to the acquisition, it was just ranked 15th. Unfortunately, 1997 and the coming years were also one of Asia's worst times to acquire a company. The Asian financial crisis, which started off when Thai baht got floated, wreaked havoc across Southeast and East Asia. Many companies went bankrupt, nations had to be bailed out, and some of the best and well-managed companies were not spared from the crisis. Due to the fact that NOL did not have the money to buy APL safely, they relied on debt. They acquired the $825 million APL company by using loans. This would have been a good decision had the crisis not occurred. Yet, nobody can really tell what the future holds. NOL then, in 1997 and 1998, had to report significant losses. In September of 1998, they unveiled several cost-cutting measures. The shipping company said wages for all staff based in Singapore will be frozen, and senior management staff have agreed to voluntary salary cuts of 5% to 10%. In the same month, the specific losses incurred by Neptune Orient was over 240 million Singaporean dollars just for the first 6 months of 1998. Neptune reported a significant decline in inbound container volumes to Southeast Asia, with a 36% decrease compared to the previous year. Malaysia experienced the most substantial drop, with a 40% reduction in volume. To recover from this, NOL had to sell some of its assets. By the end of 1998, they were looking to sell the train network of its APL unit. Some estimates said that the network could generate somewhere between $300 to $600 million, which NOL could use to reduce its massive $4.67 billion debt. It eventually sold the network for $545 million to Stack Train Services. The asset sale did not stop there. NOL was also looking to sell its headquarters, which it seeks to sell for at least $185 million. In 1999, NOL disclosed that their total losses in 1998 amounted to over $438 million, which was higher than their losses in 1997 at $297 million. Revenues, however, were still big, amounting to $6.49 billion. To continue its recovery, it also launched an international share placement in 1999. They raised about $500 million through several measures, and by 2000, the company returned to profitability. But just a year later, another downturn would occur. In 2002, it said it cut over 1,100 jobs after it reported losses of over $330 million. It would return to profitability again by 2003, reporting a net income of $429 million. That year, it would sell its crude oil transportation unit American Eagle Tankers to Malaysia International Shipping Corporation in a deal with an enterprise valued at $1.1 billion. By 2004, Temasek Holdings offered to acquire NOL and take it private. Temasek said it offered $2.80 a share for a 69.9% that it did not own, valuing the enterprise at $4.03 billion. The proposed deal, which would cost Temasek about 2.8 billion Singaporean dollars. But Temasek failed as it did not reach the required 90% stake to take it private. A few years later, NOL is again on a big move to acquire another company. They wanted to acquire Hapag-Lloyd, in a move that would make the two companies the fourth largest ocean container line. Unfortunately, the deal died down, and at the same time, the 2008 global financial crisis struck NOL, resulting in significant losses again. NOL had to pursue several measures to decrease its debt and ensure profitability. NOL returned to profitability again in 2010, but the sluggish global economic recovery led to losses from 2011 to 2014. NOL was still heavily indebted, which was about 4.8 billion in 2012, and Temasek Holdings wanted to finally cut the company off. NOL's market capitalization was about 2.3 billion Singaporean dollars at that time. Including its debt, the company's value exceeds $8 billion. At that time, NOL also sold off its profitability logistics business, APL Logistics Limited, for 1.2 billion to Kintetsu World Express Incorporated of Japan. By the end, Temasek struck a deal to sell its entire stake in NOL to CMA CGM in a $3.4 billion deal. This marked the end of Singapore's famed National Orient Lines. While many did not want to see that happen, it was too unprofitable and carried too much debt. But anyway, do let us know what you think. Thanks for watching.